For our final video of the year, we want to focus on the events and developments and trends as we exit 2015 and head into 2016. In recent months, we've been talking a lot about the decline or the downturn in manufacturing, industrial production, and trade more generally, while the service sector has managed to do reasonably well. So what I want to look at first is just the more recent trends in global industrial production. We're looking at the very recent history, as I said, focusing very much on what's happened over 2015. You see here, this is 12-month growth in IP. We began the year at a rate of growth of around about 3%, and by June that had fallen to an annual rate of around about 1.8%. So the damage was done very much in that first half of the year, and I suppose we would say that over the past, say, 4 to 5 months, we have data to October for global numbers. There's been some sort of stabilisation, although it's still looking quite fragile. What have been the key drivers, of course, of that downturn? I think we would all realise that Chinese growth numbers have been a key component of that. So that's the red line now, and they're on the right-hand scale. So China started the year with a growth rate of around about 7.5 in terms for IP growth, and that fell very sharply to around about 5.5% in the June quarter, and has also, as we said, since stabilised at the sort of 5.5–6% rate. But it wasn't just China, it was also the US and again the manufacturing sector in the US, and we can have a look here at the US ISM. You can see how that fell, or began the year at around about a 57 level. Now cold weather was to blame for the initial decline, but that continued then right through to the June quarter, a bit of a bounce, and then fell away quite sharply and alarmingly over the last 4 to 5 months of the year, partly for inventory factors, but also just the global slowdown in manufacturing and also a strong dollar would have been at fault there. Now that doesn't actually augur that well for industrial production in a sort of near-term momentum sense as we enter 2016. It's likely to produce some further downside in the blue line in the IP numbers. So the state of play as we exit 2015 for industrial production, manufacturing, China may have stabilised around the 5.5–6 on the official numbers. US is sub 50, yet to put in a base, but it is suggesting to us still that we should expect quite weak global industrial production growth as we enter the new year. Where the positives have come from, of course, has been more so out of Germany, of Europe more generally, and to a lesser extent some improvement coming out of Japan. Now I want to turn the attention to investment, because investment's been the other part of the weakness behind the global economy, with in particular with China being a substantial part of global capex, something like 25 to 30% of global capex, and that in itself, the downturn in growth rates in Chinese investment has subtracted anywhere from 0.5 up to 1% directly from global GDP growth. But let's look at some of the major developed countries individually. So we'll just bring these up, just look at recent trends in investment. So the first one will be US investment. So I'm starting at the beginning of 2014, base them at 100. You can see here that investment in the US is about 8 to 9% higher over the 2 years, or it'll end up being about 10% higher. So 4 to 5% annual growth rates, which is pretty reasonable. It's not great, but it's pretty reasonable. Now, if we look at some of the other regions, and we'll notice, I'll put up the good ones first, the UK investment has been very similar to that of the US, up by a similar amount. But now we start looking at the other regions. Japan, see there, has basically been flat over that whole period. Perhaps 2014 was disappointing, and maybe you could say that 2015 has seen a bit of an improvement, but it's only 2% higher than what it was almost 2 years ago. For Europe, very similar picture. 2014 very poor, came into 2015 with a little bit more momentum, so that's where the growth has occurred. And finally, we'll look at Germany. And as you can see here, the German numbers also very similar to the overall European numbers. So the pickup in investment wasn't synchronized. Certainly they were diverging quite considerably during 2014. Probably a little bit more promising in 2015 is that Most have been growing, some more than others. UK and the US much more consistently, with Europe starting to show at least some improvement, although even that was looking a little bit more fragile by the end of the year. Now I want to look at the bond market. And bonds actually had a sort of relatively sideways move, I guess, during 2015 after a bigger rally the previous year. So it's interesting in light of the downturn in global industrial production that bonds didn't rally more. In fact, they started to sell off. So let's just explore some of the key drivers of bonds. And one of the key sort of long-term anchor for bond yields, we believe, is the relationship with nominal GDP growth, and we can build that up by looking at real GDP growth in a sort of a smooth sense, and also underlying inflation trends. So I'm showing here US real GDP, smooth change over 4 quarters, so the most recent results somewhere in the low twos, as you can see towards the right. If we add the CPI to that, so I'll put on top of that a sort of a smooth core inflation rate. So nominal GDP made of those two components is probably a touch under 4% at the moment. You can go back here and you can see during the 1990s closer to 6%. What does that look at the relationship to bond yields? Add a line, and there we go. I'll just make that a bit darker so we can see. So now the gold line overlaying the nominal GDP build is in gold, and you can see there up until about, well, pretty much the GFC, it used to fairly well track what was happening to nominal GDP, more in a trend sense. But since the GFC, the gold line of the bond yield has tended to trade at a discount or well below the nominal GDP growth rate. So at a yield of around about just over 2% compared to nominal GDP growth in a smooth sense of closer to 4, it would appear that bonds would be quite expensive. The key question therefore is, are we likely to see an adjustment in bond yields now that the Fed has signaled its policy to normalise interest rates? And perhaps you would think that the trend would be to slightly higher bond yields, but the pace of that move higher would be slowed by a very slow pace of tightening potentially, and also, as we indicated at the start, quite weak global growth background. But nevertheless, it would appear that bonds would seem stretched on this longer term valuation tool, and if anything, the underlying pressure would be for slightly higher bond yields over the course of the year. What about for Australia when we do the same exercise? We can look at that here. That's GDP. So trend GDP growth has been somewhere around about 2%. If we add on top of that the core CPI, should be stacked. So that's now on top of that. So you can see in Australia's case, that that number has come down from probably average around about 6% up until GFC, and since then we've dived down to somewhere like 4%, 5%. And if we put the bond yield over the top of that, we can see the relationship. So it used to be closer, certainly during the 1990s, close to the nominal GDP number, but since the GFC, once again, we've seen bond yields travel at something like 1 to 2% below nominal GDP. So similar to that of the US, and indeed most global bond markets, bonds are trading sub the nominal GDP anchor, and therefore are subject to some upside pressure, given that the Fed is now moving into a normalisation process. Australia, however, we don't think is going to be moving in that direction for pretty much all of 2016. Finally, we want to have a look at some of the growth indicators for Australia as we enter 2016. We all know the mining story and the CapEx story. So I'm taking this back to the mid part of 2013, basing each series at 100. You can see here, this is overall CapEx. Now, CapEx actually during 2014 was relatively steady, but it's really been a 2015 story where overall CapEx has declined by something like 14-15%, and a lot of that has been through the mining sector, which has declined in both years, 14 and 15, but it really stepped up during 2015. So these have been major headwinds for the overall economy. If we just step back and look at, for example, the housing sector, and I'll look at dwelling approvals. Now they've had a very good second half of 2014, but pretty much for most of 2015 it's been sideways. Now that's a bit of a lead indicator, as would the housing finance data for construction of new dwellings, and that has actually been rolling over for most of 2015. So there's suggestions that the housing sector, which has been a big contributor to growth during 2014 and into certainly the first half of 2015, may in fact be less of a positive as we go into probably the back half of 2016 and definitely into 2017. So interesting offsets there. What about the retail side? And if we look at overall retail growth, again, 2014, we went from an index level 104 to 108, and since back to 112. So it's been steady, but not spectacular growth in the retail sector. Where has that growth occurred? Well, you might expect that the housing related sectors have been a key driver of that. So, but before I have a look at those, let's have a look at, say, department stores. You can see that not much has happened at all in department stores over that period, but it is very much in the furniture, floor coverings. You can see the gold line there. That's powered ahead of red line now, powered ahead of overall retail sales, quite significantly up 20% over the past, say, 2.5 years. Add in that electrical and electronic goods, similar picture. That's the gold line. That had quite a sharp increase in the back half of 2014, and that has continued during the course of this year. And then we go to hardware, building, garden supplies, the green line. That has also been very strong. So you can see where the growth is occurring in a lot of these housing related and also electrical and electronic goods, whereas others, newspaper and book retailing, you can see their structural change within the economy has led to quite a sharp downturn. So as we head into 2016, it would seem that the housing related sectors have really carried retail sales, and some other, the electronic goods sectors have carried retail sales over the past 12 to 24 months, and that probably will continue for a bit longer, but we'll need to see some, as the housing sector recovery matures and we don't get any further interest rate cuts, is our view, then we'll need to see a more broad-based pickup in retail sales for Australia to manage to offset that ongoing mining sector downturn.